Hi, good afternoon. My name is Amy Jurek and I am with REMAX. And I wanted to gather today with Brian Parkinson, my trusted loan officer from Alaris Mortgage. There has been a lot going on with the Fed this week. There has been interest rate adjustments, and I felt it was time to gather to talk about what is really going on. We want to go beyond the headlines and educate you, the consumer, about how you need to be prepared to get into the real estate market and obtain a mortgage. And we want to have all of that information up front and clear and concise so you can walk through this process with ease. So I'm going to have Brian join me. Hey, Brian, how are you?
Hello, Amy. I'm doing great. How are you today?
Doing good, doing great. Well, it's been such a wild week,
Mm.
and I just thought, gosh, we should chat and defunct or explain kind of what's going on with interest rates and kind of the market in general.
Yeah. Um, the last month has been really hard on interest rates. We were actually below 6% about
Hmm.
4 weeks ago,
Yeah.
feeling really good about it. I know you were feeling good about it
Mhm.
because consumers feel a lot better if there's a 5 in the interest rate. But
Yep.
what's happened, January's employment report, jobs report came out, and there were over 500 jobs that were supposedly created, and they were expecting 187,000 jobs created. So what happened was
Hmm.
that came out so strong, it
Yeah.
was really negative for mortgage rates,
Mm.
and it just shot mortgage rates into a tailspin. And in the last 30 days, we've seen a movement from 5.875 to over 7% due
Okay.
to some specific economic pieces.
Right.
Um, Now, this week, we had a bunch of reports coming out that I was kind of optimistic on. Part of
Mhm.
it started on Tuesday with Jay Powell,
Mhm.
Jerome Powell, who's the Fed chief, talking about what they wanted to do moving forward. But
Mhm.
see, these employment reports, when our economy continues to just really do well as
Mhm.
the feds are raising rates, it creates a problem
Mm.
because the feds feel like raising the rates isn't bringing enough to the market to slow down consumer spending, which ultimately will bring down inflation. See, what happened was in 2020 to 2022, think about all the money that was pumped into the economy through all the government stimulus. What
Yes.
happened was all this money was chasing goods,
Mhm.
televisions, cars, whatever,
Yep.
and you had a super high demand on limited product. That pushed all the prices up, created inflation of all these prices, and it took off. The government thought it was transitory, that it was related to COVID, and that
Yeah.
it wasn't that big of a deal. Well, they got caught off guard. And
Yeah.
of course, inflation took off and was, I think, over 8% at one time. So,
Yeah.
what they're doing, what they've been doing for the past, 6 months, is they're raising the short-term rates. So
Mhm.
that's credit cards, car loans, things of that nature to
Yeah.
slow the spending down. When I have a client that's looking at a 7% rate on a car, they may not finance that car. They're trying to
Yeah.
slow everything down to bring down inflation.
Right.
Inflation is the main driver that's pushed interest rates up. And
Mhm.
so it's all about these economic factors, jobs reports, the
Mhm.
inflation report, um, and the mortgage market, just like your S&P or your Dow, is very sensitive to all this daily economic information and
Yeah.
reacts very quickly.
Wow. Well, I'm going to share this grid here that you provided. I thought this was really interesting for people to see. This is a lot for a consumer to see, even for myself, in the real estate market. What is this telling me?
So I have a system and it tracks mortgage-backed securities. When you buy a house, that
Mhm.
mortgage gets sold, it
Mhm.
gets lumped together and securitized with other mortgages, and it gets sold to an investor. So what
Mhm.
you want to look at is these investors are looking at the stock market investments, they're looking at short-term secure investments. A mortgage-backed security is a financial instrument that investors buy.
Mhm.
If inflation is really low, think about it this way, Amy. If I'm an investor and I'm
Mhm.
buying a 4.5% mortgage coupon, that could be out there for 30 years.
Yep.
If my investment is 4.5%, but inflation is 8%, I'm not
Yeah.
going to buy that. And
Mm-hmm.
and I will get out of that market. Well,
Yeah.
what this graph shows is in the upper left-hand corner, you'll
Mm-hmm.
see 28 basis points.
Yep.
That's a positive number. That means the mortgage market investors were buying today
Mm-hmm.
because there was some economic factor that was positive towards mortgages. That could be the jobs report, that could be a number of different things. What this graph does, if you kind of go to the middle
Mm-hmm.
at that height where you see um, where before it starts to descend,
Okay.
that was kind of the best rates that we were seeing at 5.875.
Okay.
As market conditions changed,
Mm-hmm.
each day the market will react. And
Mm-hmm.
as this graph goes down, mortgage rates are going up. So what's happening is the red lines or bars are showing a sell-off in mortgage-backed securities. The factors are so negative for these
Hmm.
investors to buy a mortgage, they're selling off. And thus, the only way the market can attract someone to buy a mortgage backed security is to raise the return
Yeah.
and the interest rate goes up. So
Mm-hmm.
as this graph goes down, mortgage rates go up. Well,
Mm-hmm.
today, and I haven't researched it today, but there was some positive influence out there in the market that showed, uh, you know, a buying activity on mortgage-backed securities. So our last green band to the far right goes
Mm-hmm.
up, actually 28 basis points.
Okay.
Thus, mortgage pricing got a little bit better.
Hmm.
This is kind of like a daily tracking of mortgage-backed securities, similar to the stock market.
Sure.
Changes every day.
Absolutely. Once we execute a contract, you could have quoted someone an interest rate a week ago, but today it could be slightly different, right?
Yeah,
Mm-hmm.
absolutely. Until you're locked.
Yeah.
I had a file yesterday that we sent out a rate in the morning, and by the afternoon, that rate changed $1,500 for that borrower
Okay.
because the market shifted and they weren't locked in.
Yikes. Well, let's talk about the numbers of this. I want to know for buyers out there that are shopping this week, how does this affect them? I just wanted, we're kind of reviewing a simple $500,000 loan amount.
Hmm.
And it looks like, I mean, really last week we were 6.5, right? I feel like
Actually, Amy, we've been at about 6.75 for about a week to 10 days.
okay,
Yeah,
got it.
yeah,
Okay,
yep.
okay. So we just popped up a bit over 7 yesterday. Are we still there today?
Yeah, pretty much still around 7% today. Now, the one tricky part that consumers have to know is your credit score, your loan
Mhm,
amount. There are all these different factors that determine what your interest rate is going to be. This is the assumption that I've got someone with excellent credit. They're putting
mhm.
down at least 10%,
Right.
but it will vary from client to client based on their credit scores and down payment.
Absolutely. But I think this is a really fair representation of a lot of the clients that we work with.
Absolutely.
Of course, a paper, right?
Yes.
With about a $500,000 loan amount. This seems to be kind of what we call our median this year,
Yeah.
and for our shared businesses. So
Mhm.
really, if looking from last week to this week, it's a slight difference in payment, right?
Yeah, what happened, Amy, was there I just kind of ran out of space to put the
Hmm.
6.625, 675, but just to illustrate,
Hmm.
if you look at this model, the payment goes up about $40 as the
Hmm.
interest rate moves per eighth of a percent.
Okay.
So
Okay.
if you look at 6 1/8 to 6 1/4, the payment on the loan itself, not including taxes or insurance,
Yeah.
jumped $40.
Yeah. Okay. Okay. So it's yes, it is higher, but it isn't as scary as the headlines make it seem, right?
Yeah, the headlines, they're always looking for drama. They're trying to get everyone's attention. The
Right.
unfortunate thing about what I'm hearing now is, and really where I feel buyers today should really take advantage of this, higher interest rates have pushed more buyers out of the market.
Yep.
And imagine, so now we've left a seller's market per se from last year that was really tough.
Yep.
And I have seen more of my buyers that have secured properties here in the first couple months of the year
Mhm.
that are not going over list price, that are having inspections, that are getting seller paid closing costs.
Yep.
But um, rates come down, more people are going to come to the market, and that's all going to change. And I'm starting to see it change a little bit based
Mhm.
on the property and the demand for each property.
You bet. Oh, wow. I mean, I was out at a property on Saturday morning last week, $900,000 in just a very desirable part of Minneapolis, and we were crawling on top of other parties just to get
Yeah.
through the house. But again, it was
Yes.
super updated and turnkey, so that's going to attract a huge amount of people.
Yeah.
For sure. Well, I mean, if you're a consumer out there and you're a buyer, I mean, what does this do? It limits your ability to stretch. Everybody has a price range. You're going to shop from 600 to 800,000. Well, maybe you're now going to maybe not go to that highest side. You're not going to go to $800,000, right? But it could give you the opportunity to compete with less buyers,
Yes.
and we'll have a thoughtful or a cooperative uh, contract with a seller. That was something that wasn't in the cards in COVID. Sellers got what they wanted or they moved on. But now the cooperation is there. The strength of the buyers and the buyer's agent and the listing agent working together is, you know, it's how it should be.
Yeah.
We missed out on some building some of those great agent relationships during that time. So, on the flip side, sellers might, during this time where we see rates above 7, they might be asked for, helping out on those rate buy downs. They might come back into the market or be part of a conversation.
Yes.
Yep.
Yeah. The
Mhm.
Sorry. The other thing I would also keep in mind is inflation is not going to stay at these levels. The Feds have committed, they've become very hawkish about doing whatever it takes to bring that down. They're going to keep raising rates on home equity lines of credit, cars, credit cards,
Mhm.
moving forward until they get this under control. When they
Mhm.
get that under control and when this turns, mortgage rates are going to come down. My
Mhm.
message to clients today is I can't guarantee, I can't foreshadow where they'll be, but I believe in a year, year and a half, we'll be surprised. I think there's a chance we'll be back into the fives. But
Yeah.
the one thing that I shared with the client yesterday, so we talked about this very thing, taking advantage of the market. And she said, well, when rates get back to 2.5% and 3%, then we can refinance, right, Brian? And I said, Kathy, I got to be honest with you. I don't think we'll ever see that again.
Right.
That's unrealistic. That was an anomaly. I hope we never see the government artificially bring rates down like that again because it's unhealthy.
It is, and that means there's some serious pain going on, right?
Serious.
Right?
Yes.
I mean,
Yes.
you can't deny that the Fed tried to do something right during COVID and tried to push people to purchase, and yes, they did PPP loans and they forgave rent. I mean, there was some things going on that we'll never have again in our lifetime. But it kind of, there is always another couple years down the road and how that affects our economy. And now we're living through the economics of what
Yes.
happened with COVID.
Yes.
The Fed's doing a good job of trying to get people to stop buying things.
Yep.
But we know that home has never been as important as it is today.
Yes.
It is where we live. It is where we work. It is sometimes where we school.
Yeah.
And I think
Right.
everybody's become a chef after COVID. So it is also where we cook. So the message of home ownership is still strong. Getting
Yes.
a property under contract is a process. Sometimes it takes a very long time, but it is finally a time where we are on equal ground with the seller and can have a cooperative transaction, regardless of, perhaps your rate might be higher today. We might be in a refinance market in a year or two from now. So thank you, Brian, for joining me. I think everybody needs an update. We need to stay together, united, and keep people not scared of what's going on in the headlines, because this is just an adjusting market.
Absolutely. One other thing to add to that, Amy, is there's a lot of verbiage out there about a recession. There's a
Mhm,
very good chance that we will head into a
mhm.
recession. I love the economy of the Twin Cities, one of the strongest in the nation. We
Yeah.
are one of the top 10 smaller cities as far as
Mhm.
home affordability. It's a great place to live.
Yep.
Other than the Great Recession, real estate markets have always done well during recessions.
Mm,
And we are nothing like the Great Recession of 2008.
mm,
So we have a very healthy market. It would
mm.
be great if rates come down, but maybe borrowers should take advantage of it right now.
Right. Yeah. I mean, getting that property under contract is a feat that is hard to do. And it's been really challenging the last few years. So being able to get that home under contract, possibly compete less and negotiate with the seller for a chance to possibly refinance in the future, fantastic. It might be the
Yes.
approach to take this spring. So awesome. Brian, thank you so much for meeting up. Always appreciate your time. And we'll be
Thank
seeing you
you.
soon. All right.
Okay,
Thanks.
be safe out there.
Thanks.
Thanks, Amy.